Hi there, this is Mike Musial. I'm the Global Product Specialist for the Securities-Based Lending Platform at TBS, and this is the continuing series of our video cast on the Securities-Based Lending Platform. With me today, I have Mark Thompson, who is the Managing Director of Product and Capacity Management. Mark, if you don't mind, could you give us a little bit on your background really quick and your capacity here at TBS?
So prior to joining Total Bank Solutions about 8 years ago, I was a banker for 27 years with much of my focus in treasury and balance sheet strategies. I was co-chair of the Asset Liability Committee and Commercial Loan Pricing Committee at a top 10 bank. And my last assignment was head of liquidity and balance sheet liability management at that bank. After joining TBS, I've been focusing solely on the banking side of the house in terms of product and capacity management, including pricing and ensuring that we have the depth and breadth of banks needed to take our insured deposit product.
So Mark, with a background like that, I'd be really interested to get your take on how a fintech platform like our securities-based lending LMS platform can enable banks to actually utilize new technology to drive greater returns while taking less risk.
Sure, Mike. So the end-to-end automation and embedded collateral management capabilities within this platform allows for far greater control over the entire lending process while minimizing human error and greatly reducing staffing needs. Since the start of the pandemic, as many bankers know, banks have been hyper-focused on their efficiency ratios and running their balance sheets as lean as possible. So the ability to keep staffing down in what is ordinarily a more staff and FTE-centric process is critical to a bank. So in addition, the ability to lock in a spread over a given index provides flexibility while taking advantage of a rising rate environment, such as the one we're in now and what I expect will continue into 2022 and 2023 as the FOMC votes to increase rates. So this diversification away from fixed rate lending, such as resi mortgages, auto loans, and many commercial and industrial loans, is an invaluable tool for a bank's asset liability management team. Their ability to instantly load this detail into their modeling platforms for interest rate risk and interest margin modeling allows for multi-scenario testing across countless interest rate curves, for the purposes of balance sheet optimization.
Wow, Mark, that really sounds like this could possibly be a timely product. Is there any way you can get a little more specific on what some of those benefits might actually look like to a bottom line?
Sure. So absent a platform such as this, internally a bank would require up to 3 or 4 FTEs to run this lending process. With this platform, you can cut that in half. And assuming outsourcing on the vendor risk management side and the internal monitoring and regulatory response, you would otherwise need a fully staffed department of at least 6 people, if not more, in addition to the underwriting and collateral monitoring side. So with a platform such as this, Mike, you could save between $400,000 and $500,000 in FTE costs alone. That doesn't account for ancillary costs such as occupancy and other overhead costs. In addition, the great part of this platform, it is remarkably scalable. You can as you ramp up your lending in this asset class, you don't need to add FTEs or any other infrastructure. It's all built and baked into the platform. So it's fully automated and can save the bank a lot of money over a short period of time.
Thanks, Mark. That is perfect. That really puts some numbers to the concept of how it can actually save and reduce risk. So lastly, I would ask you, given all that, utilizing technology like this, do you think it makes sense for a bank to use securities-based lending to maybe diversify its overall loan portfolio?
Oh, absolutely. Now more than ever in this depressed lending environment, banks are going to be looking to spread their excess cash over multiple asset classes. As you know, the industry is sitting on more excess liquidity than it ever has in its history. So as we noted earlier, the diversification of SBL away from adds to a bank's arsenal of loans. And it's invaluable from a net interest margin standpoint and for managing interest rate risk, as I demonstrated earlier. So it also provides a great opportunity to reach deeper into the customer's wallet while significantly enhancing the customer's ties to the bank. Banks, loan officers in retail lending and commercial lending will always seek to further the relationship to keep that customer as sticky as the deposits underlying these loans. So it's an asset class also that tends to run counter-cyclically with the prevailing economic trends. So the customer who may otherwise experience difficulty in a downturn or depressed economic environment or delays in getting credit could obtain credit during this with this platform against their collateral or for an instant line of credit. And in turn, this collateralization significantly mitigates risk for the bank. So it's adding diversification, it's adding margin, and it's really helping you to really penetrate the customer's wallet and that relationship to a deeper extent than you ordinarily would.
Wow, that's great. Thank you, Mark. That is certainly a lot of information that our audience can use to evaluate their needs. And to everybody watching, please keep your eye out for more videos like this in our videocast series. You can reach them at www.totalbanksolutions.com. Thank you, and we'll see you soon.